In the world of global finance, some signals appear quietly, almost invisibly, before a major shift begins. Right now, many analysts believe the silver market may be sending one of those signals. For years, silver has lived in the shadow of gold. Investors often focused on gold when they wanted protection against inflation or financial uncertainty. Silver, despite being both a precious metal and an important industrial resource, rarely received the same level of attention. But recently, something has started to change. Behind the scenes of the global metals market, unusual activity has been quietly building. Traders, analysts, and longtime market observers have begun noticing patterns that feel strangely familiar. Some of them believe the silver market may be approaching a moment of extreme pressure. And history shows that when pressure builds inside a commodity market for too long, the release can be explosive. To understand why people are paying attention now, they first look at how the silver market normally works. Like many financial assets, silver is traded heavily in futures markets. These markets allow traders to buy or sell silver contracts that represent metal to be delivered in the future. In theory, these contracts help stabilize prices by allowing producers and investors to manage risk. But over time, something unusual developed. The number of paper silver contracts being traded became far larger than the amount of actual physical silver that exists in vaults. In simple terms, far more silver was being promised on paper than could realistically be delivered in the real world. For years, this system worked because most traders never asked for the physical metal. They simply closed their positions before the contracts expired. But every now and then, conditions begin to change. Industrial demand for silver has grown dramatically in recent years. Silver is used in solar panels, electronics, electric vehicles, and advanced technologies that power the modern world. As global industries expand, the demand for physical silver continues rising. At the same time, mining production has struggled to keep pace. Many of the largest silver mines in the world are aging. New discoveries have become harder to find. Environmental regulations and rising costs have slowed the development of new projects. The result is a tightening supply situation that many investors believe could become much more serious in the coming years. But supply and demand are only part of the story. Recently, another development has caught the attention of market watchers. In parts of Asia, particularly in China, regulators have begun taking a closer look at large speculative positions in commodity markets. Some reports suggest that authorities have started investigating aggressive short positions in metals trading. Short positions are bets that the price of an asset will fall. When large traders hold massive short positions, they profit if prices decline. But if prices suddenly rise, those same traders can face enormous losses. If enough short sellers are forced to buy back their positions at the same time, the result can be a powerful surge in price known as a short squeeze. Some analysts believe the silver market may now be vulnerable to exactly that type of event. While activity in Asian markets appears to be increasing, critics say regulators in Western markets have remained unusually quiet. The contrast between these responses has raised questions among investors who closely follow the precious metals sector. Meanwhile, another trend has been quietly unfolding. Large amounts of physical silver have been moving in and out of global storage facilities. Inventories in certain vault systems have declined over time, creating concern among traders who depend on reliable physical supply. For most people, these movements may seem small or unimportant, but experienced market observers know that physical inventory changes can sometimes reveal deeper stresses inside a commodity market. When supply tightens, while demand continues growing, the balance that normally keeps prices stable can begin to break down. And when that balance disappears, markets often move much faster than anyone expects. For now, the silver market remains relatively calm on the surface. Prices move up and down as they always have. Financial news outlets rarely discuss the deeper structural changes taking place beneath the surface. But some investors believe the calm may not last forever, because history shows that major financial shifts rarely announce themselves loudly at the beginning. They begin quietly, slowly, almost invisibly, until suddenly the pressure becomes impossible to ignore. And when that moment finally arrives, the silver market could look very different from the one the world sees today. As analysts continued studying the silver market, they began focusing on something very specific: the numbers. Because in financial markets, numbers often reveal what headlines do not. For decades, silver has been traded heavily through futures exchanges. One of the largest of these markets operates through the commodity trading system run by the Chicago Mercantile Exchange, often called the CME. Within the system, traders buy and sell contracts that represent future deliveries of silver. Each standard contract usually represents 5,000 ounces of silver. At first glance, this system appears normal. It allows miners, manufacturers, and investors to manage risk. But when analysts began comparing the number of contracts being traded with the amount of actual silver stored in vaults, something unusual appeared. On many trading days, the amount of paper silver being traded exceeded the amount of physical silver available by extremely large margins. In some periods, analysts estimated that the ratio between paper contracts and real silver reached 100 to 1. This meant that for every single ounce of real silver sitting in a vault, there could be dozens, sometimes even hundreds of ounces being traded on paper. For years, this imbalance did not cause major problems. Most traders never asked for physical delivery. Instead, they simply closed their positions before the contracts expired. But the situation begins to change when demand for the actual metal increases, and that is exactly what has been happening. Global industrial demand for silver has been rising rapidly. According to market studies from organizations like the Silver Institute, annual global silver demand recently climbed close to 1.2 billion ounces per year. A large portion of this demand now comes from modern technology. Solar panels alone consume enormous quantities of silver. Every photovoltaic cell requires small amounts of the metal because silver is one of the best electrical conductors in the world. As governments push toward renewable energy, solar installations have expanded rapidly across Asia, Europe, and North America. Electric vehicles are another growing source of demand. A traditional gasoline car may use only small amounts of silver in electronics, but electric vehicles require much more advanced electrical systems, sensors, and battery management technology. These systems rely heavily on silver. Electronics, medical equipment, high-performance batteries, and telecommunications, infrastructure all require the metal as well. When analysts combine all of these sectors together, the numbers become impressive. Industrial demand alone now consumes well over half of the world's annual silver supply, but supply growth has not kept pace. Global silver mining production has remained relatively flat for years. The world produces roughly 800 to 850 million ounces of silver annually through mining operations. Some additional supply comes from recycling old electronics and industrial materials. But even with recycling included, total supply often struggles to meet demand. This imbalance has already produced what analysts describe as a structural supply deficit. In recent years, the silver market has experienced deficits of 200 million ounces or more. That means the world is consuming significantly more silver than it produces. At the same time, another important trend has been unfolding inside global vault systems. Major precious metals storage facilities, particularly those connected to the CME trading network, have seen noticeable declines in their silver inventories. These vaults store metal that can be delivered to traders who hold futures contracts. Within the CME system, silver inventories are typically divided into two categories: registered and eligible metal. Registered silver is immediately available for delivery against futures contracts. Eligible silver is stored in vaults, but is not currently committed to delivery. Over time, the amount of registered silver available has sometimes dropped dramatically. In certain periods, registered inventories have fallen to levels close to 30 million ounces. For perspective, a single large institutional investor could theoretically purchase that amount. When analysts compare that number to the massive volume of futures contracts being traded, they begin to see why some traders are concerned. If too many investors demanded physical delivery at the same time, the available supply inside those vaults could become extremely tight. This possibility has led some observers to discuss the risk of a short squeeze. A short squeeze occurs when traders who bet against an asset are suddenly forced to buy it back as prices rise. In commodities markets, this can happen if physical supply becomes difficult to obtain. Short sellers must then rush to close their positions, pushing prices higher and higher in a very short period of time. Silver has experienced events like this before. One of the most famous examples occurred in 1980, when a powerful buying wave pushed silver prices from around $6 per ounce to nearly $50 per ounce in less than a year. More recently, during the financial crisis of 2008, silver fell sharply before launching a dramatic rally that eventually carried prices close to $49 again in 2011. Today, some analysts believe the current market structure could be even more fragile. Demand continues rising, supply remains constrained, and the gap between paper contracts and physical metal remains enormous. For now, the silver market continues operating normally. Prices fluctuate. Traders move in and out of positions. But beneath the surface, the numbers continue telling a very interesting story. And if those numbers begin to matter all at once, the reaction inside the silver market could be sudden, powerful, and impossible for the financial world to ignore. While traders continued focusing on futures contracts and daily price movements, another story was quietly unfolding inside the physical silver market. It was a story not about paper promises, but about the actual metal itself, and the numbers were beginning to attract attention. Across the global commodity system, silver is stored in a network of large vaults. These vaults are operated by financial institutions and exchanges that support trading in precious metals. Some of the most closely watched vault systems are connected to the futures market, operated by the Chicago Mercantile Exchange. For years, these vaults held hundreds of millions of ounces of silver. The metal was categorized as either eligible or registered. Eligible silver simply meant the metal met the standards required for exchange delivery. Registered silver, however, was the metal that was actually available to fulfill futures contracts. This distinction became extremely important because while total vault inventories appeared large, the amount of registered silver, the metal truly available for delivery, was often much smaller. Over time, analysts began noticing something unusual. Registered silver inventories were gradually declining. At certain points in recent years, registered silver inside the CME vault system dropped close to 30 million ounces. To understand why that number matters, analysts compared it with the size of the global silver market. Every year, the world consumes roughly 1.2 billion ounces of silver. That means the entire registered inventory in some vault systems represented only a tiny fraction of global demand. Even more interesting was the rate at which physical silver was moving. Large quantities of metal were being withdrawn from vaults and transported to other parts of the world. Much of that movement appeared to be heading toward Asia. Countries like China and India have long histories of accumulating precious metals. In these regions, silver is not only viewed as an industrial resource, but also as a form of long-term savings. When investors in these countries purchase silver, they often prefer physical ownership rather than paper contracts. That means the metal is removed from trading vaults and placed into private storage. Once that happens, the silver may remain off the market for many years. Another important factor driving demand has been the rapid growth of renewable energy. Solar power installations around the world have increased dramatically over the past decade. According to industry reports, the solar sector alone now consumes more than 150 million ounces of silver every year, and that number continues to rise. Each solar panel requires a small amount of silver paste to conduct electricity efficiently. While the amount used in each panel may appear small, the global scale of solar production turns that demand into an enormous consumption of metal. Electronics manufacturers are another major buyer. Smartphones, computers, medical devices, and advanced communication equipment all rely on silver because of its exceptional conductivity. Unlike gold, which is often recycled due to its high value, silver used in electronics is frequently lost during the manufacturing process. Once it enters small circuit boards or microcomponents, recovering it becomes extremely difficult. As a result, much of the silver used in modern technology disappears permanently from the supply chain. Meanwhile, mining production has not grown fast enough to replace it. Many of the world's largest silver mines are located in countries like Mexico, Peru, and China. While these regions continue producing large quantities of metal, total global output has remained relatively stable. In fact, according to production data monitored by organizations like the Silver Institute, global mine supply has struggled to rise much beyond 850 million ounces per year. When analysts combine mining output with recycling supply, the total still falls short of the growing global demand. This ongoing gap has created what economists describe as a structural deficit. In simple terms, the world is consuming more silver each year than it is producing. In the short term, this deficit can be filled by drawing down existing inventories, but over long periods of time, those inventories eventually begin to shrink. And that is exactly what some market observers believe may already be happening. For now, these developments remain mostly invisible to the average investor. Daily headlines still focus on stock markets, interest rates, and inflation numbers. Silver rarely appears on the front pages of financial news, but experienced commodity traders understand that physical supply trends can eventually shape the entire market. If inventories continue declining while demand keeps rising, the balance between supply and demand could eventually reach a critical point. At that moment, the silver market may begin responding in ways that few people expect. Because in commodity markets, when physical shortages finally appear, prices do not move slowly, they move fast. And the quiet shifts taking place inside vaults today could one day become the trigger for the next major move in the global silver market. As the supply situation tightened, another powerful force began shaping the silver market: global competition. Countries around the world were quietly entering a new phase of industrial expansion. Governments were investing heavily in renewable energy, advanced electronics, and next-generation infrastructure. And many of those technologies required one critical metal: silver. Unlike many other industrial materials, silver has a unique combination of properties. It is the most electrically conductive metal on Earth, the most thermally conductive, and one of the most reflective materials known. Because of these properties, modern industries depend on silver in ways that were impossible just a few decades ago. One of the fastest growing sectors is solar energy. Governments across the world have been racing to expand solar power capacity as part of their long-term energy transition plans. According to global energy data monitored by the International Energy Agency, solar power installations have grown at record speed over the past decade. In some recent years, the world added more than 400 gigawatts of new solar capacity in a single year. Every solar panel contains small amounts of silver used in conductive paste that transfers electricity through photovoltaic cells. While each panel uses only fractions of an ounce, the enormous scale of global production adds up quickly. Industry reports estimate that solar manufacturing alone now consumes 150 to 200 million ounces of silver every year, and projections suggest that number could increase significantly as solar energy expands further. Electric vehicles are another rapidly growing source of demand. A traditional internal combustion car contains only small amounts of silver in its electrical systems, but electric vehicles require far more complex electronics. Battery management systems, power inverters, charging components, sensors, and advanced safety technologies all rely on silver. As a result, electric vehicles can use 2 to 3 times more silver than conventional cars. With global EV production rising rapidly, this demand continues increasing. Electronics manufacturing is another major consumer of the metal. Modern society depends on billions of electronic devices: smartphones, laptops, tablets, medical equipment, communication networks, and industrial control systems. Nearly every one of these technologies uses small amounts of silver inside circuit boards and electrical connectors. While the quantities per device are small, the global scale is enormous. Each year, the world produces billions of electronic components, creating a steady stream of silver demand across the technology sector. Medical technology also relies heavily on silver. Because silver has strong antibacterial properties, it is widely used in wound dressings, surgical equipment, water purification systems, and specialized medical coatings. Hospitals around the world depend on these properties to prevent infections and improve patient safety. When analysts combine all these industries together, solar energy, electric vehicles, electronics, and medical technology, the total demand becomes staggering. According to data tracked by the Silver Institute, industrial applications now consume well over 55% of the world's annual silver supply. That means more than half of all silver produced globally is used by industry rather than investors. This shift has changed the dynamics of the market. In the past, silver demand was often driven primarily by jewelry and investment buying. Today, industrial demand plays a much larger role. And unlike investment demand, industrial consumption cannot easily disappear when prices rise. Factories still need the metal to manufacture products. Solar companies still need silver to build panels. Electronics manufacturers still need it to produce devices. This creates what economists call inelastic demand. Even if prices increase significantly, many industries must continue purchasing silver simply to maintain production. Meanwhile, governments are accelerating their technological ambitions. Major economies such as the United States, China, and countries across Europe are investing billions of dollars into clean energy infrastructure and high-technology manufacturing. These investments are designed to secure long-term economic growth, but they also increase competition for critical raw materials, including silver. At the same time, the supply side remains limited. Developing a new silver mine can take 10 to 15 years from discovery to full production. Exploration, environmental approvals, infrastructure development, and financing all require time and enormous capital. This means supply cannot quickly respond to sudden increases in demand. As a result, even small changes in global consumption can begin to shift the balance of the market. For now, the silver market continues operating normally. Prices fluctuate day by day. Financial news outlets rarely discuss the deeper forces shaping the supply and demand balance. But beneath the surface, the numbers are becoming more difficult to ignore. Industrial demand continues rising, mining supply remains constrained, and global competition for critical metals is accelerating. If these trends continue, the pressure building inside the silver market could eventually reach a point where prices must adjust to restore balance. And when that adjustment finally happens, it may happen much faster than most investors expect. While industrial demand and physical supply were tightening the silver market, another powerful force was beginning to influence the price of precious metals, the global monetary system itself. Over the past 2 decades, central banks around the world have dramatically increased the amount of money circulating in the financial system. After the financial crisis of 2008, governments and central banks introduced massive stimulus programs designed to prevent economic collapse. Trillions of dollars were injected into global markets through bond purchases, emergency lending programs, and near-zero interest rates. One of the most powerful examples of this policy came from the Federal Reserve in the United States. Before the 2008 crisis, the Federal Reserve's balance sheet was less than $1 trillion. But after several rounds of quantitative easing, that number expanded dramatically. By 2021, the Federal Reserve's balance sheet had grown to nearly $9 trillion. Similar policies were implemented by other major central banks, including the European Central Bank and the Bank of Japan. The goal of these policies was simple: inject liquidity into the financial system to stabilize markets and support economic growth. For a time, these strategies appeared successful. Stock markets recovered, credit markets reopened, economic activity gradually resumed, but the long-term side effects of this massive monetary expansion are still being debated today. One of the most visible consequences has been inflation. In the years following the global pandemic, inflation rates in many countries climbed to levels not seen in decades. Rising energy prices, supply chain disruptions, and strong consumer demand pushed the cost of living higher across much of the world. When inflation rises, investors often begin searching for assets that can protect purchasing power. Historically, precious metals such as gold and silver have played that role. This is one reason why interest in the silver market has started growing again among long-term investors. Another major trend shaping the market is the gradual shift in global reserve strategies. For decades, many countries relied heavily on the United States dollar as their primary reserve asset. Government bonds issued by the United States were considered among the safest investments in the world. But in recent years, some nations have begun diversifying their reserves. Central banks have increased their purchases of physical gold as a way to reduce dependence on traditional reserve currencies. Although silver is not typically held in large quantities by central banks, changes in the global monetary system can still influence its price. When confidence in fiat currencies weakens, demand for tangible assets often increases. Some analysts believe the world may be entering another period of monetary transition similar to earlier decades. Throughout history, precious metals have experienced their largest price movements during moments of financial uncertainty. For example, during the inflation crisis of the 1970s, silver prices rose dramatically. At the beginning of that decade, silver traded near $1.50 per ounce. By early 1980, the price had surged to nearly $50 per ounce. That represented one of the most dramatic commodity rallies in modern history. A similar pattern appeared after the financial crisis of 2008. Silver traded near $9 per ounce during the depths of the crisis. Within 3 years, the price climbed again toward $49 per ounce in 2011. These historic moves have led some analysts to believe that silver may still have significant upside potential. In recent discussions among market strategists, long-term price targets for silver have become increasingly ambitious. Some projections suggest prices could eventually reach $100 per ounce if industrial demand continues expanding, while monetary instability grows. More aggressive forecasts have even suggested the possibility of $150 to $200 per ounce in extreme scenarios. Of course, not everyone agrees with these predictions. Commodity markets are complex, and prices are influenced by many different factors, including interest rates, currency movements, and global economic conditions. Short-term volatility is always possible. Silver has a long history of sharp price swings both upward and downward. But when analysts step back and examine the broader picture, they see a market facing several powerful forces at the same time. Industrial demand continues rising due to technological expansion. Mining supply remains constrained. Physical inventories have shown signs of decline. And the global monetary system is navigating an uncertain period of high debt and rising geopolitical tensions. When these forces combine, they create conditions that can sometimes produce dramatic changes in market behavior. For now, the silver market remains relatively calm on the surface. Prices move gradually as traders react to economic news and financial data. But history suggests that precious metals often remain quiet, right before their most significant moves. If the current trends continue building pressure inside the system, the next chapter in the silver market could become one of the most important financial stories of the coming decade. As analysts step back and examine the full picture of the silver market, one realization becomes increasingly clear. Several powerful trends are beginning to move in the same direction. And when multiple economic forces converge at the same time, markets can change very quickly. To understand why some investors are paying close attention to silver today, they often begin with a simple comparison. Gold and silver have historically moved together during major financial cycles. For centuries, the relationship between the two metals was measured using what traders call the gold-to-silver ratio. This ratio shows how many ounces of silver are required to buy 1 ounce of gold. For long periods in history, that ratio remained relatively stable. During the 19th century and early 20th century, the ratio often stayed close to 15 to 1. That meant 15 ounces of silver could purchase roughly 1 ounce of gold, but modern financial markets changed that balance. In recent decades, the ratio has frequently moved much higher. At certain points during financial stress, it has climbed above 80 to 1 or even 100 to 1. This means silver has often traded much cheaper relative to gold than it did in earlier historical periods. Many analysts believe this imbalance could eventually correct itself. For example, if gold were to rise to $7,000 per ounce and the ratio returned to 40 to 1, silver would trade near $175 per ounce. If the ratio tightened further to 30 to 1, silver prices could theoretically move above $230 per ounce. These projections are not guarantees, but they illustrate how dramatically the price of silver could respond if historical relationships begin shifting again. Another factor analysts examine is the size of the global silver market compared with other financial assets. Despite its importance to modern industry, the total value of all investable silver in the world remains surprisingly small. Estimates suggest that the total above-ground silver bullion available for investment may be worth only a few $100 billion. To put that into perspective, a single large technology company like Apple Inc. has a market value measured in trillions of dollars. Even a small shift in global investment flows could therefore have a significant impact on silver prices. If large institutional investors begin allocating even a small percentage of their portfolios toward physical metals, the effect on such a relatively small market could be dramatic. At the same time, geopolitical trends are beginning to influence commodity markets in new ways. Many countries are attempting to secure long-term supplies of strategic resources. Critical metals used in advanced technology, including copper, lithium, rare earth elements, and silver, are becoming increasingly important for national economic security. This has led governments to strengthen domestic supply chains and build strategic reserves of key materials. Silver's role in renewable energy, electronics, and defense technology makes it part of this broader competition for resources. Meanwhile, global debt levels continue rising. According to data monitored by institutions such as the International Monetary Fund, total global debt has grown to more than $300 trillion when government, corporate, and household borrowing are combined. High debt levels can place pressure on financial systems because economies must continue expanding in order to service that debt. If growth slows while debt remains high, governments and central banks often respond with additional monetary stimulus. Historically, periods of aggressive monetary expansion have sometimes benefited precious metals. This does not mean silver prices will rise in a straight line. Commodity markets are rarely predictable in the short term. Prices can experience corrections, sudden rallies, and long periods of consolidation. But when analysts look at the structural trends, supply constraints, rising industrial demand, monetary expansion, and growing geopolitical competition, they see a combination of forces that rarely appears at the same time. This is why discussions about silver are slowly returning to the financial conversation, not just among individual investors, but also among economists, commodity strategists, and institutional portfolio managers. For now, the market continues operating as usual. Traders watch charts, factories purchase metal for production, investors debate future price targets. But beneath that daily activity, the numbers continue moving toward an interesting point of convergence. If supply remains tight, if industrial demand continues rising, and if global monetary pressures intensify, the silver market could eventually enter a phase where prices adjust rapidly to reflect those realities. And when that moment finally arrives, the quiet signals appearing today may be remembered as the early warning signs of a much larger shift in the global financial system.